you're raising $2 billion and you want to deploy it at 8 million of transactions, it's going to be very difficult.
Any deals currently that you guys do under the syndication model?
In the last 20 years, we've done one small thing outside of our funds. Otherwise, everything is inside.
Is that still the case today? Is there a maximum acquisition price, overall source and use that you do not want to surpass?
85% of all the transactions in the United States are kind of in that middle mark. They measure that a couple ways.
What made you transition from the asset management role to the investment role?
At the time, I was running asset management team, and I was an asset manager, like player coach. And then I started.
Welcome to another episode of the Dealmakers Chronicles. Today, we're joined by Tom Burton, a seasoned industry leader and the Chief Investment Officer of APR Capital Partners. Welcome to the show, Tom.
Well, thank you. Thanks for having me.
Absolutely. We really look forward to having you on the show because you come with a wealth of knowledge, and we're excited to learn, and maybe viewers as well.
Well, good. I'm sure it'll be fun.
Yeah. So take us back to the beginning. I've seen you've done billions of dollars in transaction volume. So before we get to the heavy stuff, tell us how you got into real estate in the first place.
Well, I got out of college and worked in public accounting for a few years, and had this idea I wanted to work in real estate. And I'm not sure why, because I didn't have any real estate clients when I worked in public accounting. When I went to college, I applied as an architecture major, thinking for some reason, I thought I wanted to be an architect. But I couldn't get in the architecture school, which was very, very difficult, very competitive. So I just went into the business school and got an accounting degree. So I guess I always had an interest in real estate kind of at one level or another. And then I went back to school, and got an MBA. And at that time, I did major in real estate. And sure enough, began to look for a real estate career coming out of grad school. I graduated in 1990, which was a very, very difficult year to secure any job, let alone one in real estate. It was a very, very difficult time. We were coming out of the savings and loan crisis, and so there really weren't that many real estate jobs being secured at that time. I was lucky to find one. I think an insurance company in Baltimore was trying to hire somebody to help them with their real estate portfolio. So I'm very lucky that I was able to find something at that time. And that's kind of how I got started. The company I work for today was also based in Baltimore, and I knew the guy who was running the company because I had sent him a letter back in the day when you applied for a job by sending your resume in an envelope in the mail, and he had called me up and said, "Look, I got your resume here. We're not hiring at the time," but he was nice enough to call me and just introduce himself. So when I moved to Baltimore, I kind of introduced myself in person to him, and one day he called me and said that they actually were trying to replace somebody. So that's how I ended up at what was then Alex Brown Realty.
Did you ever at any point consider residential real estate? Because I see a lot of people who come from accounting backgrounds and legal backgrounds. For some reason, oftentimes they go towards the residential side. Like, was commercial always the primary focus for you?
Yeah, I think so. I mean, residential, it's sort of two areas. You could just become a realtor, right? And I have plenty of friends who have pursued that career and have done very well. All of us probably know somebody in that career. And then there's home building, and that's probably hence more of what my career has been like. There's more capital involved. I think one way to distinguish it is is there a lot of capital involved or not, right? And of course in home building there would be, but I never really thought of the residential side. I was always more interested in the commercial side.
What was your initial role after the MBA when you joined that first real estate company? What were you responsible for?
Well, they like a lot of insurance companies, they had a portfolio of mostly mortgages, but also some direct equity interest in real estate, and they were hiring somebody as an asset manager. So this company was called USF&G. It's now owned by St. Paul Insurance Company, but they actually had two portfolios. It's kind of interesting. They had a very traditional real estate portfolio for an insurance company, which again would be mortgages and more conventional real estate assets like apartments and office and maybe industrial. Then they had a different portfolio run by a totally different group of people. That's who I went to work for initially. And that was, uh, I guess at the time, again, I wasn't part of originating that portfolio. I went there to kind of manage it and so forth. But they had a portfolio of golf courses and resort properties they were trying to build. It was more, I guess, higher yielding, meant to be a little non-traditional, and complement the more traditional investments. I started in May, and in August they merged the two groups. So I ended up, and it was very lucky for me because I had the opportunity to work on more traditional investments, which is where I've spent most of my career. But they merged the two groups, and I served as an asset manager. So as an asset manager, your responsibilities are to monitor the whatever the business plan of the investment is, of the property. Just monitor that plan. And real estate, there's always something dynamic going on. Maybe you're struggling with leasing, or maybe you're thinking about hiring a new property manager, or maybe it's time to refinance or sell. And the asset manager is going to be responsible for overseeing those kinds of activities, which would differ from, of course, the property manager, which is way, more day to day. But that was my first job working as an asset manager. It's actually a great first job if you want to have a career in real estate or real estate investment. I would say asset manager is a good job. The other thing that turned out to be a blessing was, again, we were coming out of the savings and loans crisis, right? This is the RTC days, this is the early 90s. And most of the assets that this insurance company owned, which wouldn't have distinguished them from other owners, but most of them were underperforming, substantially underperforming. So the loans that they owned, are underperforming. The assets they own are underperforming. So your job becomes more of a workout job, working out the problems and trying to establish recover value and deciding what to do about borrowers who are defaulting on their loans and so forth. It's actually a really good way to start a career in real estate because you're just constantly puzzle solving. You have to value assets in a challenging environment. Like, it's really hard to tell what things are worth when there's not a lot of trades, and anything that is trading is probably trading under distressed circumstances. It's kind of like boot camp for real estate. It actually turns out, and I've had told young people today that are looking for careers in real estate, look, if you can find a workout group, it's actually a really good place to start your career in real estate. Hopefully the market recovers, right? It always does. At least it has historically. And then you find yourself deploying capital as opposed to trying to protect it.
Yeah, no, absolutely. Even now, like a lot of sponsors we work with, some of the better underwriters and acquisition guys come from an asset management background because I think you understand expenses much better. You can look at a T12 and fairly quickly see which things are out of line on the expenses and so forth. So I think asset management is probably like one of the best kind of positions you can do to begin. So you joined ABR in 1992. So you've been with them for over 3 decades. My very first question is, was there some kind of a big party for you at the 3 decade mark?
Did we have a big party? No, as it turns out, being there for 3 decades doesn't really distinguish me at the firm. Today, of 30 people, 28 people, the average tenure is about 16. So I have several colleagues who have been there 30 years or more. On July 22nd, we're going to have a luncheon for a colleague who's retiring. If she stayed to August, she would have been there 40 years. So no, they didn't have a big party for me. Like I said,
it was just another guy working for 3 decades, right?
Right. It's like, another guy for 3 days. Yeah, there's no like special pin or something. Maybe we should adopt that. It's a good. I'm glad you planted the seed.
I mean, 30 years is a long time. So when you joined ABR in 1992, it was still evolving out of a single asset syndication model. What did you see in that firm that made you want to grow with it and stay for such a long period of time?
Well, initially, what attracted me to the firm, so before I'm working there, what attracted me to the firm is it was founded by an investment bank called Alex Brown and Sons. And if you like history, it's a really interesting history. Alex Brown and Sons, in 1992, it was the oldest investment bank in the country, founded in 1800. And until the mid 80s, it was still run by the descendants of Alexander Brown. So they had founded this real estate platform in the 70s, and then it was bought out of the investment bank in 1991, so just a year before I came there. So one of the things I knew is that Alex Brown and Sons just had this fantastic reputation for being really smart investors, very good fiduciaries. They just had this great reputation around Baltimore and really around the country. And I didn't know a lot about what Alex Brown Realty did, like sort of day to day. I hadn't worked there, so I didn't really know the culture. But I imagined that the culture and the people that worked there were probably very consistent with the reputation that Alex Brown and Sons had. And sure enough, that was exactly the case. So when I went there, they were doing single asset syndications. Although we actually did have with 6 public limited partnerships, which it's not really a fund, but it hints of a fund, meaning it's a set amount of capital, and it's like pooled capital to buy multiple assets. And so they had already begun to do some investing in a pooled vehicle, but most of it, as you mentioned, was single asset syndications. It was very interesting what they were doing. The timing was interesting. Again, the early 90s, there were a lot of assets available for purchase at what, at least based on historical values, would have seen very attractive pricing. The people that I work with, quickly became obvious to me. They're very smart, but they're just good investors, pretty entrepreneurial. I mean, we definitely would invest in things that were, I wouldn't call them pioneering, but they were, a little different. They were, very open-minded, very well supported still by the old investment bank and the partners of the firm. So at that time, the firm still owned the old investment bank still owned a little bit of the platform, as did a handful of partners of the investment bank. So the culture was still crossing over. But I think as much as anything else, it was very intellectually stimulating. Like very quickly in my career, I found it really interesting what they were doing, and it was easy to get up and go to work early and stay late. But, I always enjoyed what we were doing.
How big was your team when you first joined the entire company? Not so much the investment banking side, but more in particular to real estate acquisitions.
Yeah, again, it was called Alex Brown Realty at the time. Probably about 22 people. It's pretty small.
And that's what it is now, more or less, right?
Yeah, now it's a little closer to 30.
Okay.
It's a very scalable business. So one of the things that we've done over time is we've raised the size of each deal. So you might own 10 assets that you could own 10 assets that each costs $2 million, and now you're managing $20 million of equity. Or you could own 10 assets that each cost $10 million, right? And now you're 5 times as much capital. And the typical private equity firm, the larger your AUM, the larger your profits, right? It's very highly correlated. But it doesn't really take any more people to manage 10 assets at 10 million than it does 10 assets at 2 million. So that was really I'd say the reason that we were able to scale the business without raising the headcount. I mean, if you run a business like ours, I mean, your largest expense is salaries, because you just grow the AUM, or grow the AUM by growing the deal size a bit. As we did that, we never wanted to go outside of that middle and lower middle market range that we like so much, that we have distinguished ourselves so well in, that offers something to our clients that others don't have. But we could be an average of 10 and still do a very good job at that, and have a pretty good platform with not many more extra people.
Are there any deals currently that you guys do under the syndication model, or everything now is the fund model where you raise the capital and then you go out there acquiring?
Yeah, I'd say in the last 20 years, we did one small thing outside of our funds. Otherwise, it's always, everything is inside no, we really have two vehicles we're investing through today. One is our traditional value add fund that we call the Chesapeake series, ABR Chesapeake, 1, we're on ABR Chesapeake 7 today. And then about a year or so ago, we organized some investors into what we call a GP fund, and that was pretty small, $40 million. And we just deployed that around some small GP investing. But that's really it. So no, we're not doing single asset syndications anymore.
And these funds, they're continuation funds, or they have a time when that you guys reload the fund?
No, they're not evergreen. They have a time frame. They usually have a 1-year marketing period, a 3-year investment period where you're acquiring assets, and then a 7-year period after that. And if you run a fund model, for value add at least, the earlier you can conclude. So don't take 7 years, take more like 4.5 to 5 years, and then it wouldn't be unusual to, if you ran that model, to have above average results for the fund and your investors. So you could be, in theory, it could be from the very first investor on the very first day during the marketing period. In theory, they could make a commitment that could last for 11 years before they got the last distribution. But it never really works out quite as long as that.
Yeah, I agree with you. With value add, majority of the return and the benefit of the real estate that you get is in the initial years where you actually did the value add capex, you turned over the property, and then it's the slow year-over-year growth, which if you exit before you enter that slow year-over-year growth, you have that big IRR.
Right. That's it. Now I will say it's interesting. When I joined the firm, the majority of our investors in the single asset syndications were high net worth individuals, maybe a small endowment, but or a family office. And their orientation was, they were interested in attractive internal rates of return, but they were also very interested in, good nominal returns. So it was not unusual for us to buy things and with a plan to hold it for 7 to 10 years. We did a lot of financings, with a 10-year horizon, very consistent with the intent of the investment. But as we started to grow into the fund model and started to raise capital from institutional investors, which are, as you know, are really more interested in internal rate of return. It can't be like a high IRR and a 1.1 multiple, right? But so as long as you get in the sort of 1.5, 1.6, 1.7 multiple, and then you try to drive as much IRR as you can. With that kind of strategy, as you point out, like once you've added all the value, you've executed the business plan, the internal rate of return for that particular investment, like it's not likely it's going to increase. It might even decline if you held it for another couple years. So we actually in around 2010, coming out of the great financial crisis, and of course we didn't sell a lot of assets, during that sort of 08, 9, 10 time period because values were down. But on the heels of that, we actually created a new position called the disposition officer, whose job it was to focus on helping us sell assets under the theory that the investment decision was made very deliberately, very thoroughly. We have a whole protocol for how we make investment decisions. Then we might be able to actually add a lot of value if we took that same mindset on the disposition side. Like, what's our protocol for selling something? How do we approach it? Who's responsible for making sure that we optimize our exit when it's time to sell? And that's actually served us very well. that wouldn't have been needed back in the old days, right? Because you weren't really thinking about selling assets as much as you were, and as promptly as we kind of evolved into more of a fund model for, and particularly with institutional investors.
Do you recall the early syndications? For when you joined the company, what was an attractive IRR for some of your partners that went in with you, some of the limited partners? Like, what were they happy with?
That's mid-teens.
Mid-teens.
Yeah, mid to high. Yeah, I'd say mid to high teens was usually. Now remember, that you have to think about these in various points of cycle. Assets that we were acquiring in the early '90s, many of them. I mean, I can think of them. I was an asset manager, not an acquisition officer, but we were able to acquire them at a period of time when values were substantially depressed, right? Coming out in the RTC days. So achieving those kind of returns, even over a 7 or 8 year period, it wasn't unusual. To get into the mid to high teens results. Of course, as the market it recovered and values recovered, you had to come up with slightly different approaches to achieve those kind of returns.
What made you transition from the asset management role to the investment role? Is it something that you gravitated towards too, or it was a natural transition for you as part of the company growth?
Well, it's interesting. The guy who hired me, who ran the business for about 40 years himself, I think we never talked about this when he hired me, but I had a feeling. I guess in hindsight, he must have thought, I might evolve into an investment officer. And I had an accounting background. I was a really good accountant. You might have also said, I bet Tom's just going to be like a good monitor, a good asset manager. Will he ever develop into someone with the more creative process of all associated with it in the investment side? But apparently I did. Maybe I did with his help, the other partners of the firm. But at one point he just asked me. He said, we have some things we're working on. Why don't you work on them? Why don't you underwrite them? Be part of the underwriting. So I was at the time I was running the asset management team, and I was an asset manager, like player coach. And then I started to do underwriting for various transactions. And then at one point we had raised one of our earliest funds and saw some opportunities. Just had been introduced to some people on the West Coast where we had never really been that active. And I went out to California and started to meet people and underwrite deals, and eventually evolved out of the asset management side and just did exclusively investments.
Which type of assets did you focus on when you first, got onto the acquisition side?
It was pretty diversified. The early acquisitions that I was responsible for, some retail, some industrial, an office property, some multifamily. Interestingly, early in that period, it's around 2000-ish, we met a group that was trying to build a practice of building hotels in California. So this group had a lot of experience developing hotels. The two principals of the group, their whole careers were almost exclusively hospitality. And they had begun to look at opportunities in California. What their thinking was it's so hard to build here that if you could get something built, it could be very valuable. And of course they were right. So everything took longer, but once it was completed and stabilized, it did very well. And so actually one of the earliest transactions I worked on included two hotels. And it's not like I had a lot of hotel experience, but I had to sort of learn it. Now the firm had hotel experience, but I couldn't have given a lecture on how to underwrite a hotel at the time.
When you first had your acquisition, the very first one, do you recall all the details, the numbers, everything, or is it I was done with it and kind of moved on?
I probably don't recall all the details and and the
Do you
number.
remember what the feeling was like, or was it, oh, I'm part of a larger company. This doesn't necessarily belong to me as much. It's just part of a process. It was just another day at the office. Or did you get any kind of excitement? Wow, this is my first one. The future looks good for me. Like, do you recall the kind of emotion you were going through when you were actually underwriting your first deal and the close?
You know, I I remember thinking early on in my career, I remember thinking, like, how do you create any excess value when everybody can do the same thing you're doing? And what I realized is that, and this should have been obvious to me. It's obvious to all of us today, right? But real estate has so much imperfect information. Now it's getting more perfect with CoStar and so forth, right? Um, and some people are more talented at uh, executing business plans than others. Some people are more talented at seeing value than others. And and I remember over time coming to realize that that you actually can do very well in this industry if if you work with good operating partners who just have that kind of skill set. So one of the first investments I did, we um, we knew a guy in Florida. In fact, he had run the firm. He had run the firm back in the early '70s. He was one of the earliest. Well, he may have been the original president of the firm when they started in 1972. But he had moved to Florida, and he had built a commercial real estate business that included hotels. And he saw an opportunity to buy a an old apartment property in Coconut Grove, if you know that area of Miami. It's a very cool area. It's an old apartment property, and he was close to Marriott. This is probably late '90s. He's very close to people at Marriott. Marriott wanted a residence in that market, and just finding land and finding a site just was too difficult. So he convinced them that they should give him a residence in flag, and he would convert this old apartment project to a residence in. It's a great location. It's actually just across the street from a Ritz Carlton that was being delivered on at about the same time. So he brought the opportunity to us. So as an investment officer, like today, all my acquisition officers, their job is to originate these opportunities. I didn't originate this. I didn't originate the relationship. The people who ran the firm knew this guy, but I was responsible for underwriting it and doing all the due diligence and then making the presentation back to the team. Like this, I think this makes sense. So it was really a great experience. It was the process of converting this was full of puzzles and moments of challenge and so forth. And I just watched our operating partner kind of address each of those one at a time. There were times he had to come to us and get our input on dealing with this. But by the time we were done, we delivered to the market a residence inn in a fantastic location. Now it doesn't look like the residence inn that you would build today, of course. We converted something into a residence inn, but it did very well. It was very rewarding, and years later we sold it. It was a very good outcome for us. It was one of the first things I worked on. So it's not like somebody said, "Hey, you're an acquisition officer, go." It was more work on deals with us. Here's something somebody brought us. Why don't you underwrite it? Go see it. All the while, I'm still an asset manager, and by then, I overseeing the asset management team.
I would say it's pretty uncommon. Maybe back then it was a little different to see somebody who underwrite deals across multiple asset classes. Typically, you have an acquisition, underwrite multifamily or industrial, or hotels. It seems like you were able to do all of the above. Is that correct?
I was, and our team always has been. Now we have evolved over the years to today we're in the market with a fund that is really focused on what we call shelter and logistics. And so by shelter, we mean rental housing and maybe a little allocation to hospitality, and logistics is really means industrial or warehouses. But yeah, most of my career, I mean, if I went through all the things, we once invested in a 9-hole golf course. We invested in 2 driving ranges. There was a time we did a lot of residential land investing, commercial land investing. We've owned assisted living facilities. We actually at one time owned a portfolio of nursing homes. When I joined the firm, we had a portfolio. We had 28 parking lots and garages around the country. So I've always been very lucky to have, I mean, I've just been exposed to a lot of different property types. Having said that, I just told you we're focused on shelter and logistics. I think that's I think of all the things we've ever done, I'm very convinced that, at least for us, like that's a great place for us to be focused on. Later in our discussion, I can tell you about sort of what we're really looking for in those 2 verticals.
Absolutely.
But it also, and I tell our acquisition officers this, I say, look, I had the fortune of spending my career looking at like all kinds of different property types, and it was very intellectually stimulating, and it was profitable for the firm. We had good outcomes, and I'm watching us evolve to a more focused kind of investment theme. Do you need to ask yourself, like, is that good for your career? Are you going to be happy doing that? Because your career is going to evolve a little bit. You're not going to spend time looking at something very unusual, which may or may not be profitable, right? But it is certainly interesting. It's intellectually stimulating. Your job satisfaction is high doing that. But I think our model today is much better, and I think our outcomes will be better. And as I said, having spent time in parking garages and everything but prisons and marinas, I tell people. I mean, I'm very convinced that for us these 2 verticals are really the smartest place for us to be focused on.
And from my understanding, your focus is in middle market, correct? I mean, that's been almost from the very beginning. Is that still the case today? Is there a maximum acquisition price or an overall source and uses that you do not want to surpass? Do you want to stay within a certain kind of limit? Or is it, we're okay doing an $80 million deal and a $20 million deal?
I think in our core fund, our Chesapeake Series Value Add Fund, we're very, very focused on middle, and I'd say even lower middle market. We know that in the United States, for almost my entire career, 85% of all the transactions in the United States are kind of in that middle market, and sort of measure that a couple ways. But today you might just say, well, how many transactions occurred last year below $35 million? And you're going to find like 85% of them are below $35 million. Most of our peers, our real estate private equity peers, are raising funds that are so large that, as best we can tell, it's very difficult for them to access the middle market. So if you're raising $2 billion and you want to deploy it at $8 million a clip, like that's a lot of transactions. It's going to be very difficult.
You need an army of acquisition guys.
Right. Maybe with AI you could do it today, right? But as a result, we don't see a lot of institutional or professional competition for what we acquire. We see a lot of, and it depends on the cycle, right? But we sometimes see very highly levered entrepreneurial buyers. Today those buyers are really out of the market because no one's getting a 72% loan for something. So we like that space. And when I say lower middle market, that's associated with usually aggregation strategies. So for example, we have a partner that we've been acquiring truck terminals with. A truck terminal, all in could be $6, $7, $8 million. So the equity check might only be $2 or $3 or $4 million. And I would call that lower middle market. And yet, if we could build a portfolio of those, like that could be a pretty good strategy. In fact, in our last fund, what we call Fund 6, we actually built a portfolio of 22 truck terminals with an operating partner. We have a couple of other strategies that are what I'll call lower middle market, probably aggregation oriented strategies. If you brought me if you brought me $100 million investment, it's going to take 35 million of equity, and I have a $350 million fund. Honestly, I'm not sure I want 10% of the fund in one, in one asset. We like the diversification we get out of this lower or low, middle or lower middle market space. So I'm not saying it's not like I would delete the email immediately. Frankly, this would be way more interesting if an existing operating partner, because as you know, like everything we do is with an operating partner. If we have an existing operating partner that brought us something, and it just had a unique and great set of circumstances associated with it, yeah, you might be open-minded to it. In which case, maybe you get a co-investor to help you with that. So could somebody who would invest right next to the fund. So maybe the fund does 10 million, and you get two co-investors that each do 10 million. And then in the marketplace, there are investors who are interested and open-minded to a closed-end diversified fund like ours. And there are investors who really like to have more discretion and only want to invest directly. Sometimes they do a little bit of both. But there's a whole, there's a whole, sort of collection or stable of investors who are very interested in co-investments. So you match it up like that. It's kind of a long-winded answer, but we don't go looking for it. If it starts there, we don't go looking for big deals. If it shows up, maybe.
Yeah. So you mentioned that you invest with operators. In what capacity? Do you come in as a limited partner or do you co-JV deals with them?
We do a little bit of both. I mean, we are the co-GP, and then we're also the LP. But we always control major decisions, and they're usually responsible for day to day, and I always think of us as more like strategic. We're like head of the strategic planning division, right? And we control major decisions.
How open are you to working with new operators in your fund? What percentage would you say are the guys you've worked with and built a relation with versus the guys that bring you a brand new deal?
So if you look back at our last 3 or 4 funds, probably half of the transactions are with existing partners, and the other half are with new operating partners. So we have an absolute bias for existing operating partners, folks that we've known for a long time, who know us well, who we have a great relationship with. But we have always, and we always will be meeting new operating partners. So I could just think of even in Fund 7, we've begun to deploy some capital. All of it to date has been with existing operating partners, and yet we have 2 or 3 new operating partners that we're spending a lot of time with and underwriting opportunities with them, and very hopeful that by the time we're done, Fund 7 will include opportunities with those new operating partners.
So what you've done, take it from a syndication model to a fund model. With all the sponsors we worked with, majority of them are syndicating their deals. So it's always a dream of theirs to get to a place where they can really tap into the fund equity and to be able to do deals quicker without having to raise for individual deals. Which part would you say was the most challenging to transition from syndication to a fund, or was it an easy process for you?
Well, it was a bit of an evolution, right? The earliest funds actually co-invested next to, and they were small, like 30 million or 40 million. They would co-invest next to an investor. So we'd go find a property. I'm going to pick a number. It needed 8 million of equity, and we might do half of it out of the fund, and then the other 4 we would call some of our other investors who may or may not be in the fund, probably not in the fund, and the fund would invest next to those 4, 5, 6, 7 investors. By the time we got to 2005, we raised what we call Fund 3. It would actually have been the 7th pooled vehicle, but we didn't start the Chesapeake Series name until we got to the 4th pooled vehicle. So we call it, in any event, it was Fund 3, 2005. We raised $255 million. And and most of it was institutional investors. And we very deliberately sort of transitioned our approach to investing and how we managed assets. So before that, we had an investment committee, but it wasn't very formally organized. And we developed whole complete protocols and processes on how do we source investments, how do we approve them, how do we asset manage them. It's kind of like we wrote for ourselves. We like wrote an internal manual. We never called it that, but we wrote and developed all the policies and procedures and protocols to be very good at again, 255 million. We bought 50 assets in that fund. Like, that's a lot of assets, and so it's just a lot of volume. And it was clear that to process all that volume, it was going to be really important that we were very organized and had well understood protocols for how do we get something approved. So go back to 1992. Honestly, if somebody found something and did some underwriting, like, they could take it down to the CEO's office, and maybe while he's there, another partner is sitting in the room with them and just talk about it. And next thing you know, we're starting to put an offering memorandum to buy. That's very different than having a biweekly meeting with the investment committee to review every investment, and having an investment officer present a phase one approval request, and on the heels of that, beginning technical due diligence. Like, now we have a whole script for how we do it, which you need to. So that was kind of the evolution. Your friends and peers that do things one off and want to evolve to more of a fun model. I mean, I think the first thing I would do is just I would get very deliberate around how you do things. I would create policies and then adhere to those policies so that you can represent, that you're disciplined, right? That we have a discipline to what we do. Certainly, you want to build a track record. I think everybody wants to be in the fund business, and we love being in the fund business. I think we're very good at it. I think it's a challenge. It comes with, you got to fundraise, which is challenging. We are a registered investment advisor, so we have a lot of compliance protocols that we adhere to and so forth. So you'd have to decide whether you want to be an RIA or not, right? Puts you in a whole another league of challenges and obligations. I think they're good, and we were happy with them. I think we would do a lot of this even if we weren't an RIA. It just is, all the policies and so forth. It's just smart. But I think those are the things they have to think. It's really interesting because I have friends who, like, I'm never going to raise a fund. I'm just going to go. I find something. I've got a bunch of people that I know will always invest with me, and then they don't ever have to put a fundraising team together or put a pitch book together, right? An offering that, like, they don't have to do that. But they also don't have discretion. So it's two different models.
Do you think it's possible to grow into a very large company where you're managing 2 billion, 3 billion assets under management only through syndications? You think that's possible? Have you seen that?
I think if you had if you had some very large investors, probably in a programmatic way, you could probably do it. I mean, look, this is what Almanac backs those kind of managers, right?
Mm-hmm.
We have an old partner who is backed, and Almanac's not the only one, but is backed by Almanac. So my partner he's not in the fund business. He kind of sort of has one investor. But I think it could be done. It's an interesting question. Everybody wants to have their own fund, so I get it.
Yeah, but I would think even your operators, if you're coming in as a limited partner with them, it's almost like a syndication where they don't have a fund model, but they're getting an investment from somebody. So that's a good way to grow, is to have more pragmatic relationships with limited partners. Probably the easiest way.
The step between single asset syndications with lots of investors and a fund is, I would argue, probably a programmatic relationship. Go find an investor who likes your style of investing, and maybe, in fact, like a good version of this is you have one programmatic relationship for this vertical that you're in, and another. We have a value add strategy and we have a core strategy, and they could be two totally different investors, right? Or it could be different property types. Most of our operating partners only do one property type, but you could do two. I mean, we have partners do two or three. That would be a good bridge. It would seem to me. But the day you decide you want to raise a fund, you just have to step back and think about all the things you're going to have to do, right? You have to have an offering memorandum. You're going to need a pitch book. You're going to need a plan. Like, what's your fundraising campaign plan? You're going to need a team of people to do it. Usually the principals are very involved, but are you going to hire somebody to do this? You're going to take a lot of meetings. It absolutely can be. Obviously, it's being done, and there is an appetite in the marketplace among investors for vertically integrated managers. So it's like there's a demand for it, certainly.
You mentioned before the difficulty raising money, right? It's always, like you said, it requires a lot of work, a lot of meetings. Would you say recently it's been harder to raise money than it was, let's just say, in the early teens, like 2013, 14, 15, with the high rate environment and all the, doom and gloom kind of views about real estate?
Well, I don't know that it's harder. Now, you can look at just industry statistics and see that in the last few years, the time in the market to closing is longer, right? We're now like almost 2 years. I think it was 2 years, and most recently maybe it was 23 months, which is basically the same as 2 years. And there's been less capital. So there's been less capital raised, and of the capital raised, it's more concentrated in, say, the top 10 managers. So we're not a top 10 manager, and most managers aren't, right? Only the top 10 are. So I think it has in some ways it has gotten more difficult. The challenge for investors to commit, those challenges vary. So there are times when, for example, the public equity market is very depressed, and when that happens, there's this what they call the numerator effect, right? Like the sudden, you want to be 10%. You want real estate. I'm just using real estate as an example. We want real estate to be 10% of our portfolio. But now, what used to be $1 billion portfolio is $700 million, right? Because of the equity market came down. Maybe the real estate even stayed the same, but now we're actually over allocated to real estate. So this I admit, denominator. This denominator effect is like it does happen. It's not happening now. Now I think what's happening more often is that investors who have an allocation to alternatives, real estate, private equity, those investors are not getting a lot of distributions in the last 2-3 years, and as a result, and yet they still have some commitments outstanding, right? Things they committed to 2 or 3 years ago in the drawdown fund, like they still need to fund those. So unless they are growing their corpus in some other way, like the pension fund is growing or something, like it's hard for them to commit to. It doesn't have to. Could be real estate. Could be any private equity. Anything that's illiquid. Like it's just hard for them to commit because they're not getting distributions from their existing managers the way they used to. It's frustrating for us to hear that because we actually are making distributions out of our funds. So like the re-ups for existing investors have gone actually pretty well, but we hear this issue from other investors that their managers aren't making a lot of distributions, and so it's just harder for them to recommit. I think the other thing, or to commit to a new manager, the The other thing that's happening right now, and this is not the only time in history, right? But this just feels like there's a lot of uncertainty in the marketplace. So is it smarter for us to just sit, step back for a minute and not make a lot of new commitments? Of course, what we also know is that it's also these times that that asset values drift down. They're certainly not elevated, and it could be from a vintage or cycle perspective. I mean, it could be a very good time frame. We seem to observe like the individual investors seem to get this the earliest, and the institutional investor, then their consultants, who are of course representing like they're a fiduciary for somebody else's capital. So you can respect that they want to be a little more cautious. They are a bit more cautious as best we can tell.
Yeah, I think what you mentioned is absolutely correct. Like we're seeing that with the conversations we're having, right? The institutional capital is kind of in a wait and see moment, but at the same time, we're seeing a lot of opportunities in the market where because
Yeah.
they got burned in the last 2, 3 years, there's no distribution. Some of the funds that they've invested into lost all of their equity,
Mm-hmm.
which we're starting to see that, especially if properties are in Texas, Florida, the taxes and insurance have wiped out a lot of equity in that area. But this is a good time to actually get in because property values did go down, the cap rates did go up in those markets significantly. So it's an interesting dynamic where technically they should be looking into it, but because of the prior experience, they're holding off.
The other thing that I keep reflecting on it in the context of cycle is that anybody who's deploying capital today is doing it at lower levels of leverage than most historical periods. So if you think that you're still targeting the same return, I'm just going to pick a number. Let's just say you're still targeting an 18, but now you can only get like 58% leverage, whereas years ago you could have gotten 65. Like all things equal, that's good. Like that's really good. And I would also argue that in order to get to that 18, you had to somehow find an opportunity that underwrote even with an elevated interest rate. So that leverage is lower and the interest rate's a bit elevated. So, I mean, unless you are overly ambitious in your income growth or your exit cap, which I mean, I haven't met people that are feeling overly aggressive in their exit caps. It has to be your purchase price. Like it has to be your basis, right?
Yeah.
Somehow you have to get in at a basis, and I just think it just naturally means that the only things that are, at least for us, like the only things that are really underwriting are things where our basis, our entry point is very attractive, in our opinion, because we don't have the advantage of higher leverage. We don't have the advantage of lower interest rates.
Right.
The benefit of. We're not comfortable, expecting cap rates to decline. So we're not comfortable underwriting that rents will grow, substantially above inflation. And, although there are reasons to think that they might, it has to be your basis, has to be your entry point.
Right. You have to make the money on the buy in today's market.
Right. There's still a lot of work to do. I mean, right. There's still a ton of work to do. You got to plan. You got to execute that plan. But first things first, you just have to find things that, that a seller is willing to transact at at probably a price that they're sorry about, right? They probably didn't initially have that price in their model when they bought it, several years ago.
You've mentioned cycles, and you've been through a whole bunch of them, right? The early '90s was a tough time, the dot-com bust, the Great Recession, COVID, now the high rate environment. What would you say? I mean, all of them are very different. It's hard to compare. But if you were to guess, if you were to pick one, which one would you say was the most difficult one for your business and for the kind of stuff that you guys are investing in?
Well, there's probably two different types of challenges. So certainly during COVID, the biggest challenge was uncertainty around like everything. not just capital markets, not just occupancy in your building, but also just like health. It felt very scary to us. Um, we, we went into super defensive mode. We reviewed all of our assets, for what risk we thought we might have. We owned some student housing at the time. Remember, COVID happens in March mostly, right? March of 2020, and a lot of schools just sent all their kids, right? Like, you go home. My daughter was a senior in college. She came home and finished her term with us. And so I'm just using student housing as an example. So it didn't take much to feel very panicked that come September you wouldn't have any residents. And are they really going to pay their rent? Are they going to find a reason not to pay their rent? Now, as it turns out, at least we didn't own 30 student housing properties. We owned, I mean, 2 or 3 at the time. They went back, and their parents, they didn't want us to hang out with their parents. They would rather go back to their rooms and wear a mask or whatever they had to do. And the parents were on the hook for the rent anyway. So it was fine. It all worked out. Those turned out, not because of COVID, of course, but turned out to be very good investments for us. But I would say, in terms of like levels of anxiety, high levels of anxiety at that time. Great financial crisis is different. That was more about a complete lack of liquidity in the marketplace. At least, our experience. I mean, there certainly was, job losses, which reduces the demand for certain property types, right? But you have long-term leases in your office, but any new leases are going to be hard. If you own apartments, we found like people start losing their jobs. If they're not moving home, they want to double up. So 3 bedrooms do better than 1 bedroom. And at that time, we had a fair number of assets that were financed with CMBS loans, and they, of course, began to underperform, went into default, and we found it very difficult to transact or even negotiate with the CMBS lenders. So, like, I don't know which one was worse, I guess is what I'm trying to say. Like, they were both very, very, very challenging. What is kind of interesting is, like, we thought, coming out of COVID, there's going to be great opportunity. In fact, we rewrote our pitch book as if this is a rerun of 2009, 10, 11. Like, there's going to be a lot to buy. Honestly, we didn't see that. Right, part of that's because interest rates went to like kind of zero, and anybody who had capital started to deploy it at very low cap rates. Whereas coming out of the great financial crisis, we bought a lot of assets at really great values, and that's that's sort of 9, 10, 11, even 2012 time frame of high quality assets at what we felt was a great value. Two very different very different sort of events with different outcomes. And we were wrong about that. Like I said, I remember working on the pages. We rewrote the pitch book that, we're so well positioned for this environment. Honestly, it never really evolved. Yeah, coming out of COVID.
Currently in the capital markets, right, it tightened up significantly compared to what it was in 2021, 2022. Some lenders closed their books, some lenders changed their guidelines. So it's a lot tougher and more expensive to get credit. How much worse was the Great Recession time period getting credit? Because you mentioned you were able to purchase assets after that. The credit markets, how quickly did they recover compared to where they are now?
Well, today you have a lot of debt funds that are. If we build a pie chart, for those 2 periods, I think we would show that the debt funds are much larger participant in the. Think of it as like new origination, right? They're just a much larger participant. So things can get done today, or even coming out of the COVID period with a group of lenders, that really didn't. It's not saying they didn't exist at the time. There just weren't as many of them. They weren't as active. Of course, their return requirements. The pricing seems elevated, but they exist because they can get elevated pricing because the banks are kind of sort of, and they're coming back, but they're missing out of the market. Coming out of the great financial crisis, when you bought some things all cash and then put debt on it, I remember doing that. We had a line of credit at the fund that allowed us to do some of that, not a lot, but I definitely remember buying some things. I remember buying a loan all cash, and then later, now we own it. Now we can go take our time, find a lender. We found, the banks, there were still some banks that were making loans. I suspect, again, we're not $100 or $500 million investor. I might be wrong, but I suspect it was easier to find a $3 to $13 million loan than to find a $300 million loan. Because there's just more small banks. Not all of them were so adversely impacted coming out of the great financial crisis that they couldn't make some loans. But it's a great question. Yeah, we definitely bought some things all cash and then put debt on them on them later. But there were still some lenders out there.
So you work with a lot of operators, and obviously you look at the deal, you look at the spreadsheet. But outside of the spreadsheet, what else do you look for in an operating partner? Are there certain personality traits, or is it only the numbers? If the numbers make sense, we go into business with them.
Well, you definitely need operating partners who have a track record. What we're interested in is usually something that's going to require a lot of labor to add the value. So you can't just have an idea. You actually really need to have a track record. And it's very, very unusual for us to be a new manager's first investor in a deal. Now, maybe if you just came out of a shop, where you spent 10 or 20 years, and you have a lot of experience, but we're not good for that. So track record is important. The other thing that is important is there's a social side to this. When you do joint ventures, now we control major decisions, and we can decide when to sell, when to refinance, replace the manager. But we really don't want to invoke those rights. We want to collaborate with our operating partner on what's the smartest thing to do and how do we do it. And so to do that, it's great to get to know the operating partner and just spend time with them. And it's very common for us to transact the first time with somebody that we've known for a long time. Or put it another way, we're not a great candidate for somebody that we've never met that has something with a 45-day due diligence when they meet us, in a 30-day close. We can close it. We have done it. But we don't want, we just want to get to know people. And we don't have a script for how we get to know people. We have a partner checklist, right? But that's more, objective, not subjective things. The subjective side of this is really hard. It's almost like, honestly, getting married. You just want to get to know somebody for a period of time and hang out with them, right? And then decide if you want to venture with them. So we look at transactions with new operating partners all the time, and we've looked at things with somebody. I can think of the one partner that we've done the most transactions with. We did probably 25 or 30 things starting in 1998. We didn't do their first deal. I remember their first deal. They brought it to us. We underwrote it. We spent time with them. They came to Baltimore to visit us. We passed on it. But then they brought us the next deal. And we spent more time with them and did underwrite it and went on to have a really great run with them for many, many years. So the social side is really important. I always tell our acquisition officers, I'm like, just go hang out with them. Go to a baseball game. Go play golf with them. I don't care. Just go hang out with them. Get to know them. Have them come into the office. and meet all of us. It's actually really, really important.
I mean, what you mentioned is very, I think you're spot on there. And Warren Buffett is known to say that if I'm buying a company, the first thing I look at is the management team, right? So the numbers could be great, but unless the management team and the people who are actually going to be in charge, you can, for lack of a better word, vibe with, socially, personally, have that communication with, it makes it very hard experience going through the project. Having said that, have you had operators that after your due diligence and spending time with them, that's been a difficult transaction with them and things didn't go as you wanted it?
Oh, absolutely. Absolutely. I'd like to think less so today than, 20 years ago. I think we've actually gotten better at this. We're more patient. We are more transparent about how long it might take, right? Because I mean, a big part of, I think we get a lot of credit um, for, for telling people no early on, because
Yeah.
nobody really likes to be strung along and so forth. So, we'll just tell somebody like, honestly, I'm going to underwrite this, but if, like, we're not great. We're not. You just got it under contract, and I know you have a 45-day due diligence period, which seems like a lot, but I, I'm not sure we're going to get there for you. Not that we couldn't, right? If we could get, it's not like we're not capable of a 45-day due diligence period. We absolutely are. We do it for our existing partners all the time. If somebody new, I don't know. We have no. It's also important to have no fear of missing out, right? It's really important to just, like, something else will come along. Don't worry about it. I mean, I couldn't tell you how many things I've underwritten. And the guy who ran the business before me, he was actually really, really good at this. I would spend lots of time on things, and then we'd all, it's like, nah, let's not do this. It's like, don't worry about it. Something else will come along. Don't worry about it. Something else always comes along. It does help that we're in the part of the market where, 85% of all the transactions are under 35 million. Like, it does help. Um, our opportunity set is really large.
So you work with a lot of operators, I'm sure, that initially started to work with friends and family money, but then started to work with you. Some of them that scaled, and some of them that didn't. What is it personality traits? What would you say it makes an operator who, what separates an operator who manages $10 million assets under management or somebody who has significantly more? Is it just ambition? Is it intellect? Like, how would you describe the biggest difference between those two operators?
Well, for sure, our operating partners that have really good sized portfolios. One, they're in asset classes that it's like a repeatable thing they can do. They're not finding things that are so episodic and unusual that it's just hard to do more than like once a year or once every other year. But they also, I mean, I've just watched them. They have a plan. They all have a plan. I mean, you call it ambition, but they have a plan. They have a strategic plan, and they sit down. I'm always so impressed, But we just got back from our offsite where we did. I mean, this is my operating partner telling you. We just got back from our offsite. We were there for 3 days. We mapped out our plan for the year. That's really impressive. Like, that's a good height. Like, we know that. We learned it in business school, right? It's not like we had to read a book or to have somebody smart tell us that, right? It's so obvious. But they do it, and they're very deliberate about how they go about it. Whether they're smarter than everybody else, I think they have really good EQ. Because our industry is just so amazingly collaborative. Like, it's just hard to be in our industry and not be friendly with people and need other people to help you with things, right? So you need good EQ to socialize and work with people and be mindful of what their needs are and how, a relationship can be valuable to both of you and so forth.
So with the experience they have now, you mentioned that even if you work on a deal and you spent a lot of time on it, you still may pass on it. Are there certain things that you are look at in the underwriting, or is it like a gut feeling that you have now versus the time, in the 90s and early 2000s that allows you to pass on deals even if everything checks out?
Well, there are some, there are certainly some objective things that we're highly focused on. Um, so, for example, stabilized return on costs. Can we stabilize at a return on costs that well exceeds the expected exit cap rate, and can that exit cap rate be higher than than what's happening in the marketplace, right? So
Right.
just so if things are trading at, I'm going to pick a number, it doesn't matter what property type. If things are trading at a 6, can we hit our numbers at a 6.5 exit cap? And can our stabilized return on cost be like 150 above that? Like that gets our attention, and that's really important. And if it doesn't meet that criteria, what are the other elements of this that are so compelling? So there are objective things like that. The subjective things really are more about are you really going to find a buyer for this? So you mentioned Warren Buffett. I mean, I have in my career definitely have seen properties and strategies that I think if you had a perpetual time frame, then I think it would be great to go invest in them and not worry about the exit, not worry about whether there's institutional investors or even any investors that are going to take you out of this. But I don't have the luxury of that, right? It's a value add strategy. Once we stabilize, as we discussed early on, we got to sell it. And is there going to be a market for this? And so, that usually ends up being, sometimes it's property type, or could be location, like the location is just so tertiary, or it just could be property condition, like the physical condition of the asset. You could own it forever and generate a lot of cash flow, but I don't have the luxury of owning it forever, right? I have to exit it, and so who am I going to exit it to? So those are the things that we pay attention to. We wave off on things that I like the team, I like the strategy. Actually, I even like the property for a long-term hold, but we should just do something else.
I want to briefly touch on the fund. I know we discussed it a little earlier, the new one that you're raising. So you mentioned the direction. Can you take us through the direction, how much you're raising? I'm kind of a little more curious about the new one.
So we're in the market with a $350 million fund, and we call it Fund 7. And as I mentioned, it's focused on shelter and logistics, middle market and lower middle market strategies. And then in those two verticals, we'll be focused and are focused on, say, more niche strategies. So while we have experience in more conventional value-add investments, so a 200-unit multifamily property built in 2004, that if we get it at the right price, we could renovate all the units, renovate the common area, get higher rents, and sell it, at an attractive price. We've done that, and you can pick any property type, and we've done that kind of thing. But today we think that marketplace is very crowded. There are many very talented, vertically integrated managers, some of which have even raised funds, that are participating in that part of the market. And unless something comes to us more sort of episodically, that I think we just wave it off. Instead, we're looking for more niche strategies. So I'll give you some examples. So we have an operating partner that we have been acquiring underperforming student housing assets with and transitioning them to a conventional multifamily. Now we do this only after we underwrite and are convinced that in this marketplace, there is a really strong demand for conventional apartments, like it's spec is undersupplied, and particularly at what I'll call like a moderate price point. And we end up with in the right circumstances, we end up with really good basis. We do refresh the property some. It's not a classic value add where every unit's going to be upgraded, but we'll refresh some of the units. We'll refresh the common areas. So there's some CapEx, but this is mostly about transitioning from student to conventional And by that I mean we rent by over time. We're gonna rent by the unit, not rent by the bed. We're gonna have the leases not all expire on July 31st, right? We're gonna try to spread that rent roll expiration out over time. And we will lower the operating expenses. I mean, a lot of the value add comes from lowering the operating expenses. We'll have lower staffing, which you would expect, expect lower staffing in a conventional model versus student. We'll have lower turnover costs. We will probably have lower utilities because sometimes utilities are sort of baked into the per bed rent. And assuming the units are separately metered, or there's a way to using rubs to spread around utilities, will actually the landlord's utilities will go down, and the tenant's utility, because the tenant will be responsible for them. So that's just one example. We have another on the logistics side. As I mentioned, we've been buying truck terminals with an operating partner that we've been investing with since 2007. Not in truck terminals, but in more industrial value add. We have another operating partner that we are acquiring small triple net lease industrial properties in mostly Texas. I think we'll eventually widen that to other markets. But this is a strategy that we actually executed in Fund 6, and we're going to replicate it in Fund 7. So these properties, we're buying things, and they're small, by the way. Like the equity check might be $3 to $4 million, but if we could do it 8 or 9 times and build a portfolio, and our yields are, for these assets are 7 to 8%, it could be a very attractive portfolio to take back to the marketplace and sell, more of an aggregation idea. In the meanwhile, we've got good cash flow. We did it in Fund 6. We actually built a small portfolio in Houston, sold it early on in Fund 6, but those kind of outcomes. So that's really the plan for the fund, is more niche strategies. All of these are now done in a programmatic joint venture. We'll do some one-off investing in Fund 7, but it's mostly programmatic joint ventures.
Do you invest in, I would say, a little like a heavier lift type projects where you'll be a condo conversion or an office to multifamily conversion? Are these type of deals at all attractive to you?
We have done that over my career, and at the moment we don't have anything in our pipeline or our certainly Fund 7 portfolio that I would consider a very heavy lift. And not that we're totally adverse to it, but if I can build a portfolio of, hit my return targets, and build a portfolio of assets that don't require that heavy lift, because it does come with risk, right? There's risk of cost escalation, and certainly risk of like how long it takes to implement the plan. But we've done it. We bought an office building in San Diego years ago that we converted to apartments. Very good outcome. As I mentioned, like one of the first things I worked on, we converted an apartment project to a hotel. But we're not opposed to it, but we're not looking for those today. We've done development, and I'm not saying we won't do development again, but we're at the moment we're finding very good opportunities with these operating partners and these niche strategies. I don't think these are, as best I can tell, I don't see these kind of return levels in more conventional things, but we're finding very attractive things in these niche strategies. Like, why take on development? We might, but we're not looking for it, and we'd be perfectly happy if we didn't do new development. Perfectly fine.
Yeah, and the reason I ask is because for the deals, because we do capital markets, we advise on the entire capital stack. The deals that we see that are performing the best now are these condo conversion projects in places like New York City, where these sponsors have it to a science. They buy it, they start working on the condo book almost immediately. They get their guys in there. They literally do the construction 8, 9 months to like a beautiful state, and they have they hit 20 plus returns on all of these transactions, and it's consistent from one deal to the other because they're buying it at cost basis of a property where most people are thinking, okay, this will be just rentals. So that's why I was just curious because I would think it's a very niche thing, and you can't necessarily do this in all markets. In markets like New York City, where you buy these brownstones, this strategy works extremely well. I was just curious if if you saw anything like that.
These are you're talking about buying not office to multifamily. You're buying.
So we're seeing both, but the returns that I'm seeing that are superior to others are a multifamily to the condo conversion. So, you'll have a 6 unit multifamily property. Oftentimes the sponsor may make it 8, maybe they'll go lower, make it 4 or 6, depending on the area, and if people want bigger apartments, and then they'll sell them as condos instead of just renting them out as rentals.
So I'll put my investor hat on. What's the margin? So if your basis is 100, what are you selling the condos for?
So for the one that we're investing and we're advising on debt for 138 Geralman, their acquisition is actually, I need to pull out the underwriting. I believe the acquisition is about 4.8. They're putting about 3 million in construction. So the overall source and uses are about 9.8, and the sellout is touching 14 million. And their break-even point per net sellable square foot is about $1,600, like 1620,
Yeah,
where they're projecting to be getting 2,200.
yeah,
So, and it's a project where the construction itself should take about 12 to 14 months, and
yeah,
we're estimating about 6 to 8 months for a sale. So you're essentially fully coming out of a deal within a 24-month period. So and this is just one of them. There's another
hmm
one that we're looking at Dean Street, and we also like to invest ourselves as limited partners because like we have the privilege like doing that to see which of these deals are the good,
yeah,
and if we can throw our money in there. And like I mentioned, almost all the sponsors we work with do go by the syndication model, where it's all friends and family who come in, and oftentimes.
yeah. That's a good I mean, a 40% margin is a good margin. So you're in at about 10 million and you're selling at 14.
Yeah. And I'll send you the underwriting just for you to kind of glance over it. I mean, for this one, we raised the equity. I think, I don't know, in less than 2 weeks, I think we raised the equity for this one. Just for you to kind of glance at it, kind of see the kind of stuff that we see. It's been interesting.
But here's what's interesting to me. I'm going to guess that this is there's not a lot of cities in the country where you could execute this. New York City's a little unique this way.
Yeah.
Yes.
And in my experience, to invest in New York City, you might as well be in a different country. It's really different. And we've done it. We've done 4 things in New York City and have done very well. But boy, our experience is just so like we're so surprised at what we had to deal with, and what we never would have underwritten. So it's just and yet our partners are like, this is just normal. Like, why are you fussing around this? This is just normal. Don't worry about it. Like litigations. Like everybody's suing somebody. Like, don't worry about it. It's just
No,
like. I mean,
you
for us,
couldn't
like it's a
be.
big deal, and yet in New York City, it's like I saw that guy at lunch; it'll be fine. Like it's like okay,
You couldn't be more right. Even, you have a big multifamily syndicators, and I'm sure you know many of them. They will buy assets in Texas, in Florida, in North Carolina, in Georgia, and the business model is the same. It's literally you buy apartments, you see what you can charge for rent if you paint the walls, you
yeah,
improve the amenity area. But New York City, you need an operator who lives and breathes that area. You
yeah,
can't have somebody from elsewhere come in and take on that market. It's not an easy market to take on unless you're based there.
yeah. Very interesting. We spent a lot of time looking for things around the New York metro area. We did some things coming out of the Great Financial Crisis that did very well. They all turns out they're all. I mean, I wasn't planned this way. They've all been in the Williamsburg section of Brooklyn, and we do little deals, right? So it's not like they were very big. Um, but it was interesting. It's just like I said, we might as well be investing in another country.
Yeah, like I said, like I'll send you the deal, the one
All
we
right.
get the close on, just for you, just to kind of get an idea of what it looks like. But they're interesting and they're niche, and then they're in line with that $3, $4, $5 million equity checks. You've served on nonprofit boards and taught at Georgetown and Maryland. Would you say that those experiences improve the leadership that you have in your company?
Yeah, I think they have, and in fact, well, you know, the thing I always tell we have a small team, so like some of our young people who I think um, are very capable of leading larger teams. I'm not sure I am ever going to have a larger team for them to lead, but you can get some leadership experience outside of the firm. Go join a charity and honestly become the chairman of the board. Like we really encourage that a lot, and that was my experience. It's a pretty small organization. I wasn't really supervising a lot of people, early in my career, and even if I was, it was like two or three people. Where you become president of your local PTA, whether you like it or not, you probably have like 8 people, and plus and agendas to set and meetings to run, and so forth. So I think it actually is really, really important, and we encourage our people to do that a lot. You got to want to do it, right? You got to really like that kind of thing.
How is the experience of teaching the next generation in universities? Like,
Yeah.
I know it's probably a long time, but I mean, we graduated in 2010, and even for us, I feel like the newly grads or the kids in college are very different mentality wise.
So are you asking how did I enjoy teaching?
How do you see, like, when you're teaching these kids, are you able to connect with them because they're so different from what it used to be back in the days for a college student?
Yeah, I think I have. I taught at Georgetown in the spring of 2012, and then I'd gone to the University of Maryland, and they had a master's in real estate program, and I got to know the woman that was running that, and I ended up teaching there for 3 or 4 semesters, not successively. And I think I connected pretty well with them. One thing that's great about teaching is that, well, one, it makes you a better public speaker. So, and you can, like, and I tell young people this all the time, like, honestly, if you're in grad school or something, like, go TA a class. You're just going to force you. And then what happens if all the kids think that you're stumbling over your words? Like, who cares, right? This is where you can get better at it. But I think that's really valuable. And then it just makes you smarter, to be honest, because to teach something, you have to know it really well. So I taught a real estate private equity class at Georgetown, and one of the benefits was I had to put together like 10 or 12 lectures on real estate private equity topics. And even though I lived it, I was like immersed in it every day. To teach it is a different thing. You have to kind of be organized, put things in lists, explain how this works and how it compares to that. So I think it's really valuable. The students, the students in those programs, in the Masters in Real Estate program, I mean, they're there. First of all, they're paying an enormous amount of money. So unless they're somehow, luckily rich, like they've really made a big commitment. And almost every student, there were some exceptions, but almost every student was very committed to learning, to advancing their careers, and very engaged. And I think I connected really, really well with them because I really respected that, and I approached it that way. Like I told them many times, like I remember in one of the classes, I would give them some loan documents. And I would tell them, like, I know you're not trained as lawyers, but you need to read every single page of this. You need to teach yourself how to read a loan document. And you guys know, right? You got to teach yourself how to read an operating agreement. Like, unless you're trained as a lawyer, it's not going to be natural to you. And it's just like when you were, taking a biology class in high school, you just get out a piece of paper and just start taking notes, and you outline the thing or do whatever you need to do to understand what what it is, and then tease out the business points of this. And then when you don't understand the legal points, go ask somebody. In one of my classes, there was an attorney who was getting his master's in real estate, and I just invited him, like, Steve, tell your classmate, like, how do they get through this? How should they approach it? And he was great. So I felt like I could understand where they were coming from, and tried to sort of teach to that perspective.
So after 30 years in the industry, what still gets you excited? You've been through your first deal, your 10th deal, your 50th deal, you've mentored, you taught people. What do you look forward to now?
Well, I certainly look forward to working with, like, my colleagues, my younger colleagues, and I enjoy, teaching and developing them. I mean, that's just I really enjoy that. Honestly, I like investing. I really do. You could bring me like you and I started talking about brownstones converting to condos. Like, I'm intrigued. I I do. I like it. I like things that are a little different, a little nichey, but not pioneering. I'm not going to be great at the newest next thing. That's not, I'm too old school for that. I always have been. But I I like investing, and I do like meeting operating partners who are on a plan, who have a journey that they set themselves on to do something, and do it well, and have like a compelling thesis for what they're doing. So no, I could do that for a long time. I really like it.
Yeah, I think a lot of it is just giving back, whether for me just listening to you, whether it's knowledge or even allowing somebody to have that opportunity to be able to grow. That's very noble. So, what does the next 5 to 10 years look like for you? You've done a lot. I mean, you're more in the mentorship. You still like to invest, but if you were to, where do you see yourself going in the next 5 to 10 years?
Well, I think we have a great platform, and we would like to leverage our platform. Um, I only recently began to take on the corporate leadership. I mean, I was part of the senior management team, but the guy who ran the business retired around 2018, 19. And then I brought a colleague in, someone that I had known from another business. And so he and I run the firm together. So so I don't have 30 years of running the company. I have a handful of years of really being responsible for the strategic direction of the company. So I'd like to continue to work on that. I think we have built we've built a really great brand. I would say particularly on the user capital side. So our operating partners that we've worked with over the years, I think we have a really good reputation for being a good partner, and helping them build their businesses, and and happily help them build their net worth. So I'd like to see if we could leverage that, into some other profit types. And this GP fund kind of hints to that. That's just one small example. So I think we'd like to continue to build on that. Stay in this kind of middle market, lower middle market niche that we know so well, and we are so well networked, in that space.
hmm No, that's amazing. Tom, thank you so much for coming on. I think we ran a little over. I still had another 25 questions I want to ask you, but just to be respectful of your time, I'm gonna stop.
I love what you're doing. It's really it's great, and as you know, there's a lot of people want to be in our industry, and to learn more, through the sort of program that you all offer. It's excellent. So thank you for doing this. It's really good. It's really important.
Yeah, we appreciate that, and thank you so much. Me and my brother, we've looked forward to this conversation for like 2 to 3. Once my brother had a conversation with you and you coming on, right away he's like, okay, we're gonna have Tom Burton. He does this, and that. So we circled this date, and we really appreciate you taking the time and speaking to us.
All right. Well, if you're in Baltimore, come see us. All right.
Absolutely, for
All
sure.
right, guys.
Well,
All right.
maybe
Thank you.
Thank
All
you.
right. Take
Bye.
care. Bye.